Investors are tracking the latest economic data for any clues about growth and future inflation. Steve Leisman is here with more. Steve, what's the verdict here?
Wish I had better news for you, Melissa. A slew of ugly numbers today showing a U.S. economy slowing sharply and possibly teetering near recession. The only upside we got here was slowing inflation. Here's the data. Retail sales were down 1.1%, missing by a tenth. Gas station sales fell along with lower gas prices, but you also had autos, food and drink establishment, and department store sales falling as well. Lower inflation, a half a point down on the wholesale price index, more than expected, 6.2 year-over-year. Take out food, energy, and trade, you were up 0.1. The year-over-year, just 4.6 there and falling. Industrial production, that was a really ugly report, down 0.7% with a big decline in manufacturing output that is notable. The December retail sales report, it included a downward revision to November. It means it was a really lackluster holiday season, and there are forecasts that this is just the beginning of a consumer slowdown. Ian Shepperson over at Pantheon writing today, consumption growth is set to slow significantly in the first quarter. That slowdown likely will deepen in Q2 if we're right in expecting a slowdown in job growth. Despite the negative numbers and better inflation reports, Fed officials continue to pound the drumbeat that rates need to go higher. Cleveland's Loretta Mester, St. Louis's Jim Bullard in separate interviews saying that rates need to rise above 5% from the current level of about 4.40. Market having none of that. It continues to reject the Fed's outlook, lowering its pricing for the peak funds rate to 4.88 and for year-end 23 to 4.36. That's more than 3/4 of a point below the average forecast of Fed officials. Bond yields falling as well today on the economic reports, and the Bank of Japan's surprise move overnight not to raise the upper band in which it allows the 10-year bond to trade could be a sign it might be less concerned with inflation, but we're not hearing that from the Fed. And just before I got on, Melissa, Mike England from Action Economics says if you get a decline in jobs in January, the NBER might date a recession to this month, or the beginning of a recession to this month.
Wow. What's striking about Bullard, Steve, is that he was sticking to the rate being as high as 5.5%, which is so divergent with what the market was pricing as you had walked through. And then if you take a look at retail sales, they're not adjusted for inflation. So we did see a decline in inflation, so a decline in the cost of goods. And so that really underscores how weak that spending was in December going into January.
Right. And just so people understand the math that you're implying there, Melissa, which is that you have a decline in retail sales, but also because there was inflation as well, the real spending number might actually be more. And I will tell you, Melissa, that on my spreadsheet here, I have a running tally of the Fed market gap. And I'm only using the January 24 number that you saw on that full screen, and it is 78 basis points, which is one of the higher gaps we've seen. And as you suggest there, if Bullard's at 5.5, well, that gap between Bullard and the market is even bigger. And it's something that we have to watch how that closes. Does it close by the Fed, basically crying uncle and saying the market is right here? What would be more painful is if it closes by the market moving up to the Fed.
Yeah. Steve, thank you.